Thank you, Shane, and welcome to another slice of the good, the bad, and the orange. Today, I have one of my mentors and one of my contemporaries, which you'd think would be the same, but it's not. We have with us my good friend and really my caretaker at the gym. When I fall, he helps me up, Dan Zlaket, who is a commercial loan associate with Integrity Capital. And they specialize in commercial financing of all sorts. And we have our own Eric Forshee, who is president, CEO, and founder of Probus Companies, a construction management firm, and also our resident executive commercial agent. So today we thought people are moving to Arizona, and many of them are moving their businesses with them. And I think it's something we discovered once the pandemic surge happened, which was like July of 2020. People were saying, I'm moving, and oh, by the way, I'm moving all my assets with me. So they were bringing, they were 1031 exchanging out of buildings. They were moving their businesses and needing commercial space. And fortunately enough for us, we had Eric, who most residential agents, I can say this, have no business doing commercial real estate because it's such a different animal. And in Phoenix, the Valley, the state, it's there's so many variables that I couldn't even begin to I think adequately represent somebody when it comes to commercial. So what we thought we'd talk about today a little bit is the state of the commercial market in Phoenix, particularly Scottsdale. The state of financing, because now money is not available and it's 32%, and Dan's out there on the corner with a sign saying we'll work for Bitcoin. But I think there's a lot of misconceptions as people are moving in about what is the health of the market. So why don't maybe you guys start out with a little bit about a state of the market.
State of the commercial market is strong. It has been impacted by the economy and the downturn in the upturn in the interest rates and the change of things. We are seeing a lot more properties on the market now. When I say a lot more, we're seeing listings stay on the market a little bit longer than they have been, and they're not disappearing quite as quickly. Now, having said that, there are multiple market segments to talk about in Arizona. The residential apartment markets are very strong. As we know, the demand for rental property is very high. We have not seen any adjustment in pricing in terms of investment sales on the apartment side. And frankly, the vacancies are very low, so properties will probably continue to sell and trade in that market.
When you talk about continuing to be strong, how long can they build apartments, and where's the cap on that? I know in the single family residential rental market, we've seen rents flatten out for the last maybe 2 months even. Is that not the same in the apartment world?
I would say the rents are definitely flattening out. You're definitely seeing a change in that part of the market, but the demand for ownership, the demand for trading apartment buildings remains strong.
Okay. And so what's the typical buyer? I mean, are we talking about institutional buyers? Are there opportunities for smaller investors? I mean, how do you see that?
Yeah, so those are really two different markets. The institutional world has a lot of cash. They've been fundraising for years. There's international money. There's a lot of cash chasing apartment buildings. On the private side, the smaller apartment buildings is a different market. Likely to be more impacted by the rising interest rates, not always a cash buyer. So you're going to see fewer people who can qualify for some of those things, and you're going to see the demand kind of change in, I'd say, the below $10 million, the non-institutional. That doesn't mean the institutions don't buy those smaller ones, but bigger institutions are chasing big portfolios and big apartment complexes. Your smaller apartment complexes are really the mid-level investors who have cash, they have a lot of money, and they're looking for places to put it.
Dan, so when it comes to financing of all these investment properties, I don't know if some of the institutional investors are using, their own resources, but when it comes to the smaller investors, so not necessarily the first-time apartment owner, but what's the financing? What's the weather report on financing for small apartment buildings?
Yeah, so recently we've actually seen a huge shift in the market as far as financing goes for the Class C, B, and even A assets. So one thing that I've been kind of noticing is that the interest rates 6 months ago were in the 4% range, and in the last couple of weeks they've actually gone up to the 6% range. So you're looking at 6.5% on most assets right now. The question I get asked a lot is, how much money do I have to come in with? And that's a burning question, because the way that we do financing with apartments is we look at the cost of the asset, so your purchase price, we look at the rental income minus expenses. So it's really hard for me to say, here's exactly what you need to know, unless I have a rent roll and a P&L or a T12, which shows a
What's
rolling.
a T12?
A T12 is your rolling 12-month financials.
That's for us residential people
Yeah.
that don't know what a T12 is.
Yes.
Thank you.
Yeah, so then once we look at the numbers in that way, then we know. And on average right now, I'm seeing a lot of what we call 50% loan to value, which means 50% down. And even sometimes if we're finding a great asset, it'll be around the 60 to 65% loan to value.
So what you're saying at a minimum is 50 to 65% financing, 65 being the best option possible, 50% maybe being more prevalent as the market shifts?
That's just where we're seeing them right now with cap rates the way they are, prices the way they are, and interest rates the way they are. So, it's kind of like Eric and I have spoken about in the past. We have high prices, high interest rates. We're all staring at each other in the face. Who's going to blink first, right? Rates are probably not going to change for another 6 months, maybe more. Sellers have to maybe adjust their pricing a little bit to make it work. So then you'll get more favorable financing.
Which sounds a lot like residential. I was just talking to one of our lenders and we were talking same thing. So mortgage rates are 6.5 to 8, 7, down to 6.25. They're very volatile, but the consensus is that in residential that we probably will see rates maybe going back down to the mid 4s first quarter, because we're going to have a lot of things changing. They may eventually say we're in a recession, even though they don't want to say we're in a recession. And historically, the market will triggers the bond market to become more favorable and rates come down. When it comes to commercial, is that lag time to correction of rates longer? Meaning, if we think first quarter, because we're driven by really a different mechanism in some ways in the mortgage market than commercial rates are. Do you think that is it'll take longer for commercial rates to lower?
Yeah, so traditionally what we see is commercial lags residential by about 3 months or so. So when residential rates were up high, there were still commercial rates that were a little bit lower, but now we're starting to see that shift really occur, but it's happening quickly. So instead of it being a soft landing, it's kind of a break your back landing, right? We're feeling it. So it's definitely impacting things, which means that if, let's just say, residential rates go down in Q1, they might not go down in commercial until Q2.
Got it. Clear as mud. That's why you need experts. So, you talked about asset classes, A, B, C, I don't know if you did D. Just for the general public, so what are those different classes? So when you start talking about smaller investors, because that's really what we're talking about. We're not talking about big institutions. We're talking about the people that are choosing to relocate here or have to relocate here, but are looking at some sort of investment mechanism. When you talk about Class A, Class B, Class C, what just cliff notes? What are those differences?
Yeah. I think it's less about the classes and more about the category of real estate.
Okay.
What I was really referring to is you've got multifamily, you also have office, industrial, and retail. 3 completely different commercial markets. It's estimated about 40% of the office space, the institutional office space, is vacant right now in Arizona. That puts a lot of pressure on the pricing and the value of those buildings because they're valued based on their income, as Dan was explaining. However, on the industrial warehouse side, that market is 100% leased. It's difficult to find product out there. There's a lot of product that's under construction right now, big product, priced extremely high, much higher than what we've seen in the past. And they have to price it high to justify the construction costs today. But we're going to see several 100,000 square feet, millions of square feet hit the market here in the next 2 to 3 years, all priced extremely high compared to what's already out there now. That's going to change the pricing of everything. That's going to drive those prices up across the board. Then when you look at the retail side, retail's also remained strong. We've seen a lot of redevelopment over the last 3 to 4 years. Older centers getting facelifts and getting improved because they could finally fill them up and attract higher rents. And so we saw the rent markets in the retail side go up a lot during COVID over the last 2 or 3 years when we had so many people relocating to Arizona. So each of those markets are different. Now when you talk about Class A, B, and C, that doesn't differentiate between institutional and non-institutional.
Well, correct. I guess I use that, again, from a layperson standpoint, but you're right. It's more about commercial, office, industrial, and retail.
Yeah.
So does financing differ in each one of those cases?
It does. So, in a way, so with a vacant building, you could use it for owner-occupied purposes. So let's just say your office building is vacant and you're growing Jasper and Associates and you need more space. So you can say, hey, I'm going to go buy this building
And live in it.
and I'm going to live in it,
Ah.
right? Yeah. So
That might be a
that's,
hard sell to others in my household. But
Hey, it's all right to live where you work, right? So, in that case, there's loan programs that will be structured for owner-occupied use, which is SBA, or owner-occupied conventional bank loans. What's nice about owner-occupied is that you don't have to put as much money down.
Right.
You go in at 10% with SBA and also 20% with conventional bank loans. So there is a draw to the owner-occupied space. For investment, there's going to be a lot more pressure on that income being generated.
so are those kind of like mixed use, so where maybe you have retail on the main floor and an apartment above or a condo above? Is that kind of that type? Is that the typical owner-occupied commercial? No?
Doesn't have to be. It
Yeah.
could be an office building, a 3,000 square foot building that you occupy, for your business.
And you call it your residence. I mean, you
don't-
homestead it.
You don't live in it. It's
No.
owner occupied just means you own the building and you run your business out
Oh.
of that building.
Your
You
business
don't
out.
live there.
Look how much smarter I am getting. I did not know that. And added to the Cliff Clavin knowledge.
And the rule of thumb is 50% or more is owner occupied. So if your business absorbs 50% or more of the location, so I would say 51% to be safe, it'll qualify for owner occupied financing.
Is SBA become a more viable option than it was in the past? I mean, it's been around. Sometimes it always sounded too good to be true. What are you doing a lot of SBA?
So right now, the SBA benefits are the down payment. So you'll get 10% down, you should be able to get into an asset comfortably. Conventional bank loans, you need 20% down. So really, right now, the rates are pretty much the same, as the only difference really is SBA takes a little bit longer to close, which is usually about 90 days sometimes. The conventional bank will take 60 days. SBA requires a lot more paperwork, and they'll find everything out about you.
Intricate.
Exactly. So, at this point, if you have the 20%, go conventional, but if you don't, SBA is a good backup option.
And very interesting. So if you're moving to Arizona, you got an asset to move into, you're looking for a deal, what is that's relatively safe? Is office space because there's high vacancy? Is that a good place to put your money, looking at long term?
I would say retail, industrial, apartments. I wouldn't invest in office personally. I think there's too much uncertainty about people coming back to the office. If we're only occupying 40% of the institutional space, that's all the high rises, all the multi-story buildings in town that are owned by institutional companies. I think that there's going to be an adjustment in all that type of product over the next couple of years. People aren't admitting that it's going to change. I mean, a lot of businesses are still fighting, trying to get their people back into the office. So it remains to be seen what's going to happen over the next couple of years.
So when we talk about repurposing, so let's tear down the PV mall. We're not going to do malls anymore. We're going to do a new mix. We look at all this office space for the entrepreneurial type who is thinking about what might be the next use for office space. I know in Minneapolis there was a huge commercial building that got built way before its time, a high-rise in the suburbs. Couldn't sell them to save their life. So what they did is they converted it to residential. And in a normal condominium urban setting, made a lot of sense. So it took a long time to sell them as suburban condos. Well, now that sprawl has happened and urban has spread further out, they're actually pretty cool, but it's taken 20 years to do that. What do you think is another use that we might see for office space? I mean, there's office space all over the place, right? So something's got to happen with that. People aren't going to sit forever with vacant office space.
Well, you just said it. The biggest need in our area is affordable housing. So if you can find a way to convert an office building into affordable housing, you'll start to solve a lot of our problems. That would be, and we're seeing some of that. We're seeing developers look at office buildings and propose changes. And we're seeing cities and municipalities starting to loosen up those regulations to allow it because they need to. 2 years ago, Phoenix had what we considered affordable housing. We don't have any affordable housing anymore. So that would be the number one desired retrofit, in my opinion.
Well, and it's I was at a luxury tour meeting where they had a Scottsdale planner there, and I asked them the question about affordable housing in Scottsdale. They're talking about redevelopment or final development of the these last few pieces, and he said no one really knows how to define what affordable housing is. It's pretty hard community to community. You look at the median price in Scottsdale versus the median price even in neighboring Phoenix. It's a vastly different story, and to me it becomes now, is it really something, do we really need to provide a base level price of housing? I don't know. I mean, it's a whole other story, but that might be a solution. But again, municipalities have to say, we're going to do that, and they got to look at the tax base is different. So if you turn it into condominiums or apartments, I don't think the tax rates are as high as they are on commercial office space. I'm not positive, but I would bet that's usually true. What do you think?
Affordable housing, when you talk about the definition, is it's a calculation based on what people can afford. It's just that simple. If they don't know how to define it, the city of Scottsdale may be looking at the median income in Scottsdale and calculating what affordable housing is, and that would be very different than a Mesa calculation where the median income is much lower. But at the end of the day, you need solutions for people. I mean, we've had 300,000 people move here last year, something. So that's a
huge number.
Huge
yes.
number. I know that's high, but whatever it is, the influx of people has created the price of housing to go, in some arguments, maybe artificially high. And it makes it difficult now for people who have ordinary jobs to afford a place to live.
Yeah.
What we're actually seeing too is they call it the build for rent.
Yes.
Where you'll build a subdivision and instead of selling them, you'll rent them. It's kind of like an apartment complex but horizontal, so it's kind of interesting.
Would you consider that a commercial project?
Yes.
It is.
I bet you finance this.
Oh yes.
If you're looking to do a build to rent, Eric will find the land and Dan will finance it. In the long run, do you think they're going to convert to ownership? Or is this one more step away from home ownership as the American dream of home ownership Now we're build to rent. Is this one step further away from home ownership?
That's a really good question for a residential agent. What do you think?
Well, we were talking about that this morning. I know it's going to get off track a little bit, but there's I think the 30-somethings, and I will take Dan as an exception because he's not even in his 30s. I mean, he's the number one financier in Western United States, I think. But he's already talking about multiple home ownership, so he understands he's an exception really to the rule. There's this group that thinks that if I don't own anything, then I'm not tied to anything. The flip side of that is you're tied to a lease, you're tied to the whims of a landlord, you don't own a car, you have no equity, you're on and on and on. And because they have lost this idea of that home ownership is a key to wealth building. And I think the more these things happen, the less likely we are to have that high rate of home ownership. And yet that's what brings stability to an economy is home ownership. Because people are tied, they have skin in the game. In a lease, what do you got? You got a deposit. Yeah, I'm going to probably walk away from my last month's lease and let them keep that, and they'll probably just let me go because it's costs too much to fight it. So I think this is really a crucial time when I know it sounds great and builders think it's a great opportunity to make money, and I'm sure they will. But I think it's a dangerous path. Let's put it that way.
You know what? You could argue if you look at the markets, everything's cyclical. If
Right.
they're building homes, it's no different than 20, 30 years ago when they started converting apartments into condos and selling them off because it
Very
makes
true.
sense. So they're building all these single-family homes. Eventually, they're going to look at it and say, don't want to maintain it anymore. It's time to sell it. Let's move it on. I think it could be a positive thing.
Well, I guess it'll happen. We won't know probably. Dan might know, but you and I might not live long enough
We
to
may
know.
not figure it out.
Dan, if you were giving advice to someone starting a business or looking to buy an asset, and they haven't owned anything commercial before, and commercial can be small, what's your top 3 pieces of advice you would give to that first-time commercial investor?
Yeah, so top 3 things I would say is introduce yourself to your lender, let them know what your goal is. You can call me anytime too. I can help by pre-qualifying you. Sometimes that's basic as just getting a pre-qualification, ensure that you're in line with what your budget is and also how your business is doing. It's never too easy to get a too early, to get a pre-qualification. So as soon as you're thinking about it, start that introduction process. The next thing is, don't be discouraged if you're not there yet. There's always an opportunity down the road, and we'll help you put a plan together to get there. I think a lot of times we hear from first-time business owners or new investors is, I don't think I'll ever be able to get there. The nice thing is that right now there's a lot of different opportunities to syndicate in deals. You can put a little bit of equity in a deal, and then you'll also own some. So there's a lot of different avenues for you there. And the last thing is, the rates are going up right now, but that doesn't mean they're going to be up forever. The one thing I always say is the price you pay won't change, but the rate you're in will change. So even if you're getting a price at a certain point, you feel like you overpaid or underpaid, whatever it is, that's never going to change. So the rate will, and you can always refinance.
Marry the home date the rate.
Yes.
I see that carefully, but you're right. So when you talk about syndicated properties, Eric, do you do syndicated properties? Do you know, are you involved in that, or Dan, how do you, let's say someone wants to touch on investing. So how would they find syndicated properties where they can buy a piece?
Yeah.
Get a piece of the rock.
So there's several groups in town actually that will syndicate deals for you, where right now I'm seeing a lot of in apartments, multifamily, where they'll basically have a key principal, someone that has the experience, the wealth of knowledge, the guidance, they've done it for a long time, they have a good net worth. They'll kind of quarterback the deal for you. And let's just say I want to throw in maybe $50,000 and I want to own a part of that apartment or whatever it is that you guys are syndicating. You will have a small piece of ownership, so you'll also get the dividends as well on those deals.
Interesting. Eric, your
Yeah.
advice?
Syndicating existing product, I don't have any deals, but I do work with a couple developers who are looking for investors to invest in the development and be part of the project from the ground up.
And what about advice for a first-time investor looking to buy a property? So how do they, other than obviously they got to afford it, which they talked to Dan about, but what are some criteria, two or three things that they should think about as they're looking to buy that first investment property, the first commercial property?
I think any investment like that is a big commitment. It's not a short-term investment when you're investing in commercial real estate. Generally, you have to have a long outlook, and you need to plan on the cash flow. You need to judge do a pro forma budget so that you know when the taxes are gonna hit, when you're gonna have big, I see more investors get in trouble because they don't manage the cash flow. So my recommendation is understand the property, understand the income, but also understand the expenses. Talk to somebody like me and let me help you work through that.
Vacancy.
Vacancy.
No one thinks about that when they own a house.
No, they
Or
don't.
renting. They could be a vacancy. So just a quick touch on our market, the residential market. How are we doing time-wise? Good? 2 thumbs up. That's good. Like Cisco and Ebert. No, they wouldn't know they were. Never mind.
They never agreed.
No, they didn't. One of the things they talked about was, we've had this increase in inventory, and it's flattened out, but we just broke the 20,000 listing mark. And everyone said, well, oh my gosh, we haven't done that for, 5, 6 years. The thing to keep in mind is that the long-term average is 25,000 listings. So, we always talk about how short we were on inventory when we were down at like 4,000. And the average is 25,000. We're not even there yet, which means we're still in we still have a lack of inventory for a true balanced market. And that doesn't really even take into account the home creation shortage that we've had over the last decades. But what I found interesting was that a shortage or an excess of inventory isn't universally evenly spread. It's not the same in $2 million properties as it is in $150,000 properties. And the highest areas for inventory right now are between 350 and 600,000. And with the biggest part being, that 400 to 600,000. So we haven't, 400 to 500,000, we've never seen the active listing count this high ever recorded. And the 500 to 600, not since 2007. Does that tell you something? But the one thing they said to keep in mind is that the new median price is in the 400 to 500 range because we've gone up so much. So the reason we're seeing more inventory in that area is that is our new baseline. That's the new. It isn't 300 anymore. It's 400 and some $1,000. So we're in those ranges. We're looking between 3.5 to a 4 month inventory of houses. We're not quite. We're almost to balance. So we get that 4 to 6 month range. We'll be in a balanced market. But so the good thing is, if you're buying in those ranges, which we're seeing in our office, actually in the last 45 days, we've seen a plethora of sales to owner-occupied people under $500,000. Now, if you thought about rates being at 6%, you would think the affordability index being not very favorable to first-time buyers, you wouldn't see that. The contrary is good education on, you got 4 months, 5 months, 6 months, okay, even a year to wait for rates to drop back down. You're not going to see, when rates drop back down, what's going to happen to pricing? It's going to go back up. So it's a great time to buy. But anyhow, we're continue to see softening, but nothing like we saw in the crash. When we had high vacancies, which we don't now, talking about apartment buildings being full or high occupancy and high demand. It's quite the opposite back in 2007 when everything was for rent because you could, beyond that, the market is good. We're starting to see the seasonal license plates come in. So the Midwesterners driving slow in the fast lane. More California plates, of course, which is it's all good. It's all a good thing, but they just need to move in the right lane because we in Arizona drive the appropriate speed in the left lane. Anything else you guys have got that you like to drop? I mean, these two are guys that I respect immensely for their expertise in their field, and we'll put their web links or their emails in our description of the podcast. But Dan, any last words?
Sure. Yeah, so a lot of times I get questions about where rates are. So a good way for you guys to kind of get a gauge on where rates are is just Google simply the 5-year Treasury, and you'll get a number. Right now it's like 3.89%, and then just add 2 points to that. That's usually what your interest rate will be. So your average right now is about 5.89%, just about 6.
With a little asterisk that says subject to credit approval.
Yes, credit approval.
Or credit rating.
Yeah.
And so if you want a 5-year fixed rate, that's probably where you're going to go, is like about 6%.
Okay.
And then if you want a 10-year fixed rate, look at the 10-year Treasury, add 2 points to that. So that's kind of what you'll see as far as rates go. So everything's around that 6 range right now. We have lenders in town that are doing deals in the mid-5s still, which is really competitive. And also sometimes if you have lower leverage, you can even get a little decrease in your interest rate as well. So there's a lot of ways to benefit from this as well. I also have lenders that are doing no prepays. So if you ever needed to refinance, you can prepay. There's no prepayment penalty, so you can refinance without any fees, maybe just new appraisal.
Eric, when we talk about 6% commercial rates, what's the highest you've seen?
Well, that's about as high as I've seen recently, but
No, but I'm talking
in my
in your-
lifetime,
yeah.
oh, geez, 9.5, 10.5, 11. I've seen some pretty high rates in my
Yeah,
career.
so this is nothing.
Now these, and like Dan says, finance it today, make it work. A year from now, refinance it when the rates are going to go down. The only thing for sure is the rates will eventually cycle back down. So you'll have opportunity to improve your return. If you can make it work today, then buy it, and you can improve your return over the next few years.
So the last piece I want you to comment on, because no one can really do their own financing. People like to think they can find and buy or lease their own commercial property. Tell them why it is not in their best interest to do that.
I think a lot of people think that with the internet, they can access everything that's everything that's in the market. And when you go to a program like Crexi or LoopNet, you see a lot of properties available. What I would tell you though is what you see in LoopNet is probably 15% of the market. Because only the firms that are willing to pay for advertising are in LoopNet. And a lot of commercial real estate is not advertised on LoopNet. So if you're looking for property, give me a call. I'll help you find everything that's on the market, and then we'll work with Dan to get you financed.
I think that is sage advice.
That's great.
Well, that will wrap up our latest episode on commercial. I learned a lot. Holy cow. I'm going to have to review my notes, but I would like to thank Dan and Eric for joining us, and check us out on your favorite podcast site or on our YouTube channel. Like it, subscribe, comment, and until next time, see you soon.
Thanks for having us.
Thank you.